financial reports, they can often feel, well, less like a clear picture and more like wading through treacle, can't they?
Yeah. Dense is one word for it. So much data, so much jargon.
Right. And our job really is to cut through that noise, to find the actual story hiding in those numbers.
Exactly. Figure out what's really going on with the company, what matters for you if you're following them.
And that's what we're doing today. We're taking a deep dive into the latest update from Kumpulan, Perangsang, Selangor, Berhad, or KPS Berhad, as most people know them.
KPS, yeah.
Yeah.
Interesting group. Pretty diverse looking at the reports. Lots going on, especially in manufacturing and trading.
That's right. So for our dive today, we've got their official Q1 2025 report. That's for the quarter ending March 31st.
And we'll be comparing that, checking it against the same quarter last year, Q1 2024.
Yep. And we're also bringing in some analyst views, mostly looking back at the full year 2024, but giving some thoughts on 2025, plus the company's own press release on these Q1 numbers.
So the goal is to stitch all that together for you. Pull out the key numbers, see how the different business parts are doing, get management's take, and flag any other, important developments.
Think of it as the highlights reel, saving you the page flipping. Ready to jump in?
Let's do it. Headline numbers first.
Always. So, KPS Q1 2025. What's the top line look like? Revenue.
Okay, so for continuing operations, and that's important, we'll come back to that, revenue came in at RM 243.5 million.
Right, RM 243.5 million. How does that stack up against last year, Q1 2024? Better? Worse? Flat?
It's up, but just a bit. Q1 2024 continuing operations revenue was RM 233.8 million.
Okay, so that's carry the one, about 4% growth year on year.
Exactly, 4% growth. Modest, yes, but like you said, it does suggest the core businesses they're still running are, well, holding their own, showing a bit of resilience maybe given the environment.
Which management keeps saying is pretty challenging.
They certainly do.
Okay, revenue up slightly. Now profitability. This is often where the nuances hide. How did they do on profit?
It definitely needs a bit of unpacking this quarter. The reported profit after tax, PAT, for Q1 2025 was RM 8.2 million.
RM 8.2 million profit. Okay, now wait a second. I seem to remember looking at the Q1 2024 numbers, the total profit, and it was way higher, like RM 50 million or something. That seems like a huge drop.
Yes, and that is the absolute key point of context here. You're right. The total reported profit in Q1 2024 was much higher, RM 50.3 million PAT.
So what gives? Why the massive difference?
It was almost entirely down to a big one-off event. Back in Q1 2024, they sold off their 50% stake in a company called Kaiser Corp.
Right, the Kaiser Corp disposal. I remember that.
And the gain they booked just from that sale was huge. It was about RM 106.5 million in profit before tax, logged under their investment holding segment. That inflated the overall Q1 2024 number massively.
Got it. So that RM 50 million wasn't really about how well the ongoing businesses were doing at all. It was mostly the asset sale.
Precisely. So if you want a clearer picture of the actual business performance, you need to compare this Q1 2025 profit of RM 8.2 million with the result from continuing operations back in Q1 2024.
And what was that number?
Well, if you look at the comprehensive income statement for Q1 2024, the continuing operations actually showed a loss of RM 6.0 million.
Wow. Okay. So from a RM 6 million loss in the core businesses last year to an RM 8.2 million profit this year, that's quite a swing, a genuine turnaround.
It really is. It points to a significant improvement in how those core parts of KPS are actually running day to day.
And does that show up higher up the profit statement too, like operating profit?
It does, yeah. Operating profit from continuing operations almost doubled. It jumped to RM 13.7 million this quarter compared to RM 8.0 million in Q1 2024.
What did they say drove that improvement? Was it just the revenue bump?
Not just that. They mentioned a couple of key things. One was lower other expenses.
Vague. Any specifics?
They linked it partly to some restructuring they did in Toyopolis and also a shift in the business model for their CBB carton division last year. So some cost savings flowing through from those actions.
Okay. And the other factor?
Lower finance costs. This was a big one.
Because they paid off debt.
Exactly. They mentioned repaying their sukuk.
Sukuk, remind me, Islamic bond, basically.
That's right. They give it like an Islamic bond. Paying that down reduce their overall debt, meaning less cash going out the door to service that debt each quarter. Lower finance charges help the bottom line.
Makes sense. So slight revenue growth, but a solid profit turnaround in the core operations, helped by managing costs and cutting debt. Let's break down those operations then. Where is the action happening?
Manufacturing is the big story, no question. It counts for, what, nearly 84% of the total group revenue. Huge chunk.
And how did that segment do overall?
Pretty well. Manufacturing revenue in Q1 2025 was RM 204.1 million. That's up from RM 192.6 million in Q1 last year.
Okay, so growth there. Which parts of manufacturing were strongest? Toyopolis usually gets mentioned.
And rightly so, this quarter. Toyopolis had really strong top-line growth, up 43.1% to RM 100.6 million.
Wow, 43%. What drove that?
They pointed to new assembly projects coming online, plus strong orders in consumer electronics and also their medical divisions.
Yeah.
That strength was seen in both Malaysia and China operations.
Good to see new projects contributing. What about MDS Advance? Also manufacturing, right?
Yep. Also positive news there. They saw a recovery in top-line momentum. Revenue grew 23.8% to RM 5.2 million.
Driven by?
Mainly stronger performance in their medical division as well. Seems like medical's been a bit of a bright spot.
Okay, so Toyopolis and MDS looking pretty healthy. What about the others? CPI?
CPI was more flat. Revenue came in at RM 52.8 million, basically level with last year.
Any reason given for that flat performance?
They mentioned a few things. Lower contribution from engineering thermoplastics, that's a type of specialized plastic. Also some delays in product launches hitting the numbers, and just generally softer market demand for most things, although they did say electronics held up okay.
Right, and CBB, the carton business.
CBB faced a tougher time. Revenue there actually slid quite a bit, down 29.7% to RM 45.5 million.
Ouch. Nearly a 30% drop. What's the story there?
The company put it down to slower market demand, hitting all their divisions within CBB, plus really high competition. Sounds like a tough market for cartons right now.
And what are they doing about it?
They mentioned they're undertaking operational consolidation and business rationalization.
Which usually means cutting costs, streamlining.
Pretty much. In this context, facing lower demand and high competition, it likely means they're trying to make CBD leaner. Maybe combining production lines, looking hard at which products are actually making money, possibly simplifying the structure to improve efficiency and hopefully get profitability back on track.
Okay, that covers manufacturing. What about the trading segment?
Trading also saw growth. Revenue hit RM 39.4 million in Q1 2025. That's up from about RM 36 million in Q1 last year.
What pushed that up?
They said it was supported by better equipment sales and also steady business from their water chemicals and meters side, which is mainly under the Aquaflow brand.
And any impact from things like U.S. tariffs we hear about.
They noted that they don't expect those tariffs to have a major impact on this segment, mainly because its focus is pretty much domestic, within Malaysia.
Got it. And just for completeness, there are those smaller continuing bits, investment holding and property investment. Plus, the memory of the discontinued operations, other manufacturing, licensing, infrastructure, oil and gas. It helps paint the picture of how the group has evolved.
Absolutely. Shedding those discontinued parts has definitely allowed them to focus capital and management attention on these core manufacturing and trading businesses we've been talking about.
Speaking of capital and focus, let's touch on financial health, cash flow, debt.
Good news on the cash flow front. They actually generated positive cash flow from their operating activities in Q1 2025.
That's a switch from last year.
It is, yes. They were in a negative position, using cash in operations back in Q1 2024. Management has been talking up operational efficiencies, and this positive operating cash flow suggests those efforts might be starting to pay off.
And the cash they got from selling Kaiser Corp and potentially Plaza Perangsang, where's that gone?
Good question. The report indicates that those proceeds have been used mainly for two key things: paying down a substantial amount of debt.
Which helps explain the lower finance costs we saw earlier.
Exactly. And the rest has gone towards working capital, just funding the day-to-day needs of the business.
Makes sense. Strengthen the balance sheet, keep the operations funded. Are they investing for the future too? Any mention of CapEx?
Yes, they are. They talked about planned capital expenditure spending on things like new machinery, maybe expanding facilities specifically to boost their manufacturing capacity and capabilities.
Which sounds necessary if parts like Toyopolis are growing strongly.
Right. They need to be able to meet that demand and also position themselves for future opportunities. The Q1 report does show some capital expenditure commitments have already been approved and budgeted for.
Okay, so strategic use of funds, paying down debt, investing in growth areas. Given all this, what's management saying about the outlook? How do they see the road ahead?
Well, they're certainly not sugarcoating things. They acknowledge the operating environment is still, challenging, complex.
What specific challenges are they highlighting?
They point to a few big external factors. Shifts in U.S. trade policy that's causing ripples everywhere, ongoing fragmentation in global supply chains, making things less predictable, general market volatility, and still dealing with elevated input costs for raw materials, energy, things like that.
That's a fair list of headwinds.
Yeah.
So what's their plan? How are they navigating this?
They describe their approach as an adaptive strategy. Basically, try to be flexible and react quickly.
Really?
It involves looking for alternative sources for materials, keeping a really tight grip on costs everywhere, more operational streamlining like we talked about with CBB.
Right, the rationalization.
Exactly. And also actively trying to diversify their markets, find new customers, new regions perhaps.
Did they mention any more specific actions beyond the general strategy?
Yes, a few things. For CBB, it's that further consolidation. Across the board, stepping up sales and marketing efforts to broaden the customer base, actively looking to diversify revenue streams, making sure that planned CapEx goes to the right places, and importantly, reviewing their product mix to try and push towards higher margin products. They even mentioned exploring price adjustments where possible to offset those higher input costs.
Trying all the levers, basically. And didn't they just get a new chairman?
They did, yes. Dr. Ahmad Fazli Ahmad Tajuddin was appointed as the new non-independent, non-executive chairman in April. He took over from Dr. Karis Qasim, who retired.
And he's the Selangor State Secretary.
That's correct. Brings a lot of public sector experience to the board.
Okay. So we've got the performance, the finances, the strategy. What about the flip side? What are the key risks everyone should be aware of, both external and internal?
Externally, management is still worried about, well, geopolitical tensions lingering, general market uncertainty, which could slow down any recovery in demand for exports, and always the risk that commodity prices could spike again, hitting their costs.
And internally, based on what we've seen in the segment.
Yeah, there are definitely internal challenges too. Looking back a bit, things like managing inventory levels have been flagged before. I think Toyopolis had that note previously. Potential overstocking was mentioned for MDS in the past, though they seem to be doing better now.
And more currently.
Currently, you've got CPI, which is struggling a bit with sales traction and those product launch delays. And then CBB, as we discussed, really grappling with weak demand and that intense competition.
Did the analysts pick up on these risks too, the ones whose reports we saw?
They did. The commentary for March, looking ahead into 2025, definitely highlighted some short-term hurdles. They were concerned about potentially weaker demand, especially for consumer electronics, which hits Toyopolis and CPI, and also the risk of higher operating costs squeezing margins.
Seems like a consistent picture of the challenges. Okay, moving beyond the core financials and segments, any other important corporate stuff mentioned? Updates?
Yes, a few things worth noting. We talked about the disposals. Kaiser Corp sale is done and dusted, completed March 2024.
But the Plaza Perangsang sale is still pending.
That's right. The proposed sale to PKNS, the Selangor State Development Corporation, which makes it a related party transaction, hadn't been completed by the end of Q1.
Yeah.
So the property is still sitting on their books, classified as asset held for sale.
Okay. What about dividends? Any news for shareholders?
Nothing declared specifically for this first quarter. But they did confirm the final dividend for the full year 2024, that's 2.0 cent per share, got approved, and is set to be paid out in June 2025.
And didn't they pay a special dividend earlier?
They did, yeah, back in April 2024. That came from the Kaiser Corp sale proceeds. A little sweetener for shareholders then.
Got it. Anything else? Legal matters? Sometimes those pop up?
Yes, there were updates on a couple of significant legal cases.
Okay, what's the status? There was one involving former employees of QHCC.
Right. The trial for that claim finished back in February this year. The court's decision was expected in June, but it's been pushed back to July 2025.
And has KPS set aside any money for this?
Interestingly, no. The notes to the account state that no liability has been recognized. That usually suggests the company believes it's unlikely they'll actually have to pay out on that claim. But we'll see what the court decides in July.
Okay. And the other one, something about a land claim.
Yes, the land claim second suit. The update there is that more parties have been brought in as defendants. And these are significant names. The Menteri Desa of Selangor, the Selangor state government itself, and the local district land administrator for Kuala Lumpur.
Wow, involving the state government. That raises the stakes.
It certainly does. Procedurally, there's an appeal hearing about an attempt to get the case thrown out, and that's scheduled for August 2025. So that one is definitely ongoing and involves some major players.
One to watch. Any other housekeeping, subsidiaries being wound up?
Just a couple of mentions there. The voluntary winding up of one of their Shanghai subsidiaries, Toyoplus Manufacturing, Shanghai Songjiang, was completed in April 2025.
Okay.
And there's another one, TMV, also undergoing voluntary winding up, but they noted it's not a major subsidiary, and they don't expect any significant losses from that process, just tidying things up, it seems.
Right. Now let's circle back quickly to those analyst reports from March. You mentioned BMB Securities and Public Invest Research. What was their overall take, especially looking forward?
Okay, so BMB Securities, back in March, had a sell rating on KPS. Their target price was RM 0.53.
A sell rating. Why?
They thought the full year 2024 results were okay, kind of in line with what they expected. But looking into 2025, they saw those short-term headwinds we discussed, weaker consumer electronics demand, potentially higher costs. So near-term caution.
But they weren't entirely negative.
No, longer term, they're actually more positive about the company's strategy. They like the asset sales, the focus on paying down debt, and the plans to expand in the EMS, the electronics manufacturing services space. So short-term pain, maybe long-term gain was their view.
Interesting. And Public Invest.
Public Invest actually stopped covering KPS back in March. Their final rating was Hold E, with the target price of RM 0.78. That was based on price-to-book value, PBV.
PBV, just remind us.
Price-to-book value. It's basically comparing the share price to the company's net asset value per share from its balance sheet. It gives you a sense of whether the market thinks the stock is cheap or expensive relative to its underlying assets.
Gotcha. And why did Public Invest stop covering them?
They gave a few reasons, reallocating their analysts to other stocks, basically. They also felt there weren't many obvious catalysts, big positive triggers expected in the near future that would push the stock price up significantly. And also some specific research program commitment they had under Bursa Rise had finished.
So more of a resource allocation decision than a strong negative view.
It seems that way. Their final take on the FY24 core profit was that it was pretty much in line with their own estimate, and maybe even slightly better than what the market overall was expecting at the time.
Okay, so a bit of a mixed bag from the analysts back in March. One cautious sell, one exiting with a hold at. Highlights the different ways you can look at the same situation, I suppose?
Absolutely. Near-term challenges versus long-term strategy. It's the classic analyst balancing act.
Right then, let's try and sum this all up. KPS in Q1 2025. We saw that modest single-digit revenue growth from the core continuing operations.
Yep, about 4%. But the bigger story was the profitability turnaround in those same operations, from a loss last year to a decent profit this year.
Driven by better operational performance, maybe some cost savings kicking in, and definitely helped by lower debt servicing costs after paying down that Secordic.
Crucially, though, you have to ignore that super high total profit from Q1 last year that was the Kaiser Court sale, distorting things. Focus on the continuing ops trend.
Manufacturing is still the powerhouse segment. Toyoplus and MDS had strong quarters, particularly in medical and electronics for Toyoplus.
But CPI was flat, facing some delays and softer demand. And CBB had a really tough quarter, down almost 30%, facing weak demand and competition, prompting those streamlining efforts.
On the financial health side, positive operating cash flow is a good sign. They're using asset sale money, wisely paying down debt, funding working capital, and planning CapEx for future manufacturing growth.
And management seems very aware of the difficult external environment, trade issues, supply chains, costs, and they're pushing this adaptive strategy with cost controls, streamlining, and looking for diversification, all while dealing with those ongoing legal cases and completing some subsidiary tidy-ups.
It definitely feels like a company in transition, trying to strengthen its core and adapt to a bumpy global landscape.
They're pulling levers, that's for sure. Asset sales, debt reduction, operational tweaks, planned investment, trying to build a more resilient base.
So, maybe the final thought for you, the listener, to chew on is this. KPS has made some big strategic moves, selling assets, cutting debt, planning new investments, rationalizing parts of the business. In this really volatile market we keep talking about, how well positioned are they really to turn these actions into sustainable growth and capitalize on future opportunities when they arise?
Yeah, that's the million-dollar question, isn't it? Can the strategy translate into sustained results?
One we'll keep watching. That wraps up our deep dive for today. Thanks for tuning in.
Always a pleasure.